So good evening, ladies and gentlemen. I'm Michael Moscow, Vice Chairman and a Senior Fellow at the Chicago Council on Global Affairs. And on behalf of the Council, I want to thank all of you for being here tonight for this very special occasion. This is the fourth annual CME Group Lecture on Global Financial Markets. So a couple of comments first. This is on the record, both the talk and the question and answer. And as always, please silence your cell phones. Now, last year, we were very fortunate to host Professor Gary Becker of the University of Chicago, a legendary economist and Nobel laureate, whose seminal contributions to the field will leave a lasting mark, and as you all know, passed away earlier this year. This year, we're pleased to have with us internationally renowned economist and Nobel Prize laureate Myron Scholes. And we're delighted to present this annual lecture in partnership with the CME Group, whose generous support has made the lecture possible. And to introduce Myron, I want to turn to Leo Melamed, who's Chairman Emeritus of the CME Group and a transformative leader in the futures and financial services industries. Leo has been a true pioneer in the development of financial markets. When he chaired the CME, he launched currency futures with the creation of the International Monetary Market, which was the first futures market for financial instruments. He then led the CME in the introduction of a diverse number of financial instruments. For example, he spearheaded the introduction of a Globex, the world's first futures electronic trading system, and he became its founding chairman. More simply put, he is widely referred to by many as the founding father of financial futures. So we're delighted to have Leo as a member of our board of directors at the Council and thankful for his leadership as well as the CME Group's deep and ongoing support of the Chicago Council's work. So please join me in welcoming to the podium Leo Melamed.
Thank you, Michael, and good evening, everyone. I am really delighted to be here. First, because these events are special, and the Council serves them up to the audience in Chicago, and I don't know where in the world you could do better than that, especially the people that come before you and give us their thoughts. Tonight, as you know, we are going to hear from Myron Scholes. Now, if there's a hamlet, a town, an arena in the world that has not heard of the Black-Scholes model, I want you to show me where that is. Now, that's called famous. Really famous. So how can I introduce someone that well-known in the world that carries the name the Black-Scholes model? It's impossible. But I did some research on the way from the Merc in the cab to here. And even though we all know that Myron received the Nobel Prize for the Black-Scholes model in 1997. What you may not know is long before that, the Black-Scholes model was known and used. Now, I don't know about the moment of creation. You know, that goes back all the way to the beginning. And I don't know, but if someone told me that the Almighty or whoever it was that launched the creation must have thought, well, what if it doesn't go the way Einstein said in the first 3 seconds? What then? We need an alternative swap option, a universe alternative in case. Well, I can't prove this, but I do know this for a fact, that when in the Garden of Eden, Eve, she had talked to the snake, and she had very little information. And the snake suggested that she buy a call on the snake. In case things don't go well, she'll get the information. Now, things went okay, but she bought the call just in case. I mean, what did Adam know? Nothing, right? The Kama Sutra wasn't yet written. So Myron's Black-Scholes model saved the day. Okay, one more biblical story I must tell you. That Joseph, you remember him, and he and his brothers, he had, 12, there were 12 of them, and they knocked around whether Joseph should tell the Pharaoh what he learned from the Black-Scholes model about hedging, okay? It was a discussion, 8-4 finally decided, tell the Pharaoh, save Egypt. Let's put the hedges on with the grains for the 7 years of lean years that we're going to find. Again, I have real good sources that have told me it was the Black-Scholes model that David had that won the day. But enough of biblical stuff. When Myron finally left the academic world, all right, he had been very insulated in academia. And University of Chicago, Stanford, these kinds of places in academic study give you a feeling of safety, of knowing what you're doing. And so when he finally was leaving the academic world and going to be a senior advisor to Salomon Brothers, oh boy, and a reporter was interviewing Myron and said to him, Myron, this is going to be a shock to you. You're going from the academic world to Wall Street, and that's day and night. How are you going to handle it? And Myron said, this is all very true. And Myron said, well, you're right. It's going to be a shock to me because in Wall Street, I know it's dog eat dog. In academic world, it's the other way around. Myron, it's all yours.
Thank you. Thank you very much, Leo, for that introduction. If I would have known that it was all decided on that many years ago, I might not have done the research. Actually, it's interesting because I gave a talk. It wasn't in Chicago, but it was to a room full of accountants from PricewaterhouseCoopers. They asked me to come to Florida for their national convention where all the partners were there. And I told that same story that Leo talked about, dog eat dog versus dog eat dog, No one laughed. So never tell that type of joke to accountants. That's the major thing, okay, what happened. Well, thank you for coming tonight, and I appreciate it. I have fond respect and memories for Chicago, and it was a wonderful experience for me, a little kid knew nothing from Canada, to come to the University of Chicago and then be able to be hooked up with Merton Miller, who took me under his wing and molded this person who knew nothing and gave me a framework with which to think that set the stage for my career. So I really appreciate that. I know that Merton was on the board of the Chicago Mercantile Exchange for 13 years and was instrumental in saving the financial futures industry with Leo and other unnamed sources at the time of the '87 crash. So it was with great love that I at the University of Chicago and Chicago itself. It just was too snowy here, too cold, you know, so decided maybe I'd be smarter to go to California. Anyway, I have a talk tonight is going to try to merge together three strands that I've been thinking about. And one strand is that a paper that I have just finished up, or 98% finished up, on tracking error and the effects of tracking error on international pricing. And I was supposed to mention international pricing, so I did. And the tracking error is deviations from benchmarks, or how far we will deviate from benchmarks when we do things. But it also has to do because it touches my ideas in this paper and what I learned in doing the research, which is has a mathematical model, which I was told not to present tonight. I was going to start off with the basic ingredients of it and tease it out for you and let you see the wonders of the model. But if you wish, you can get a copy of the paper on SSRN, and Social Science Research Network, or at the university, at Stanford University Graduate School of Business website. So that's the first strand, to talk about tracking error and what that does to asset prices. And the second I'd like to talk about is I had lunch with Alan Greenspan, who we were talking about his book on the map and the territory. And Alan Greenspan is very much enamored with the idea of animal spirits and irrational behavior, irrational exuberance. And I was maybe thinking tonight of calling this talk Irrational Exuberance Rationalized. And I was, so I'm going to tie that into what I'm talking about tonight as well. And then third is I read the book by Kahneman on, think fast and think slow. And so basically, all of these ideas that we're coming towards in economics and in my area of financial economics are all leading us to believe that everything is irrational, or the idea that things are based on herds and irrational movements. So I thought it would be interesting to tie together my work on tracking error, deviations from the benchmark, with these other two themes of irrational exuberance and then the idea of behavioral attitudes and how that affects what others do. So let me start off, first of all, talking about tracking error. And tracking error is that we establish a benchmark. Most investment managers, when are hired by their clients, have a benchmark. Everything is benchmarked, and then from that benchmark, we're allowed to take tracking error or permissible deviations from the benchmark. And so the real questions that we have is that, is it the case that herding, getting to in a herd, is really rational? And is the tracking error constraints rational that we see imposed? So when we see the herd, basically people move together in the herd, and then the question is whether those who deviate from the herd are taking tracking error relative to the herd, and in what conditions that would occur. And what does that give us as an idea to think about problems and think about how we have to analyze these things going forward? So what we have seen in finance, my area, because we can measure things quite easily with so much data, is that there are return differences in markets. So we have anomalies or risk differences, and Eugene Fama who was a colleague of mine at the University of Chicago and was awarded the Nobel Prize, has done this last year, has done a lot of work thinking about trying to understand risk factors that affect returns on stocks, because when we look at the basic models that we've used for years, such as the Sharpe model of capital asset pricing, we know in that nomenclature there is something called beta, which is the idea of how asset prices change with regard to changes in the market. So some assets have high responsiveness to the market or high beta, and some asset classes have low responsiveness to the market or low beta. And what we found since a paper that I wrote with Fisher Black and Mike Jensen in 1972, followed by others, Fahm and Macbeth in 72 and others, that in a lot of papers have very strange results, is that higher risk stocks do not make the same enough money as do lower risk stocks. So as measured by either volatility or beta or residual volatility, unexplained volatility, it seems as if everything else being equal, these higher risk stocks are overpriced relative to lower risk stocks. And so it's been a puzzle for a myriad, since 1970s, it's been a puzzle as to why that's been the case. And so one strand of thought, is the Fahm school, which says, no, there are risk differences, and the model, the simple model that Bill Sharpe devised, which was elegant, doesn't explain things, and basically we have to understand the factors that will explain risks. So we've seen the whole plethora of new ideas that have come about, which everything from now called smart beta or different factors that explain returns. And then on the other hand, we have had the growth of, and by the way, these anomalous results, the fact that high-risk assets perform, are overvalued or perform under these models and perform worse than lower-risk stocks, are even true internationally. So the underperformance of stocks with high idiosyncratic volatility extends to international markets as well. And it's also true that it applies to fixed income markets, global fixed income markets, global commodity markets, global currency markets, across multiple asset classes and geographies, so that the higher risk assets tend to be overbid in the market relative to lower risk assets. And so then there's the other camp. One is the factor school camp, that we don't understand. There's various factors that affect returns. Everything's exogenous in that model. And then the other hand, we have the behavioral models, the behavioral finance models. And we have like Shiller, who was also awarded the Nobel Prize, Bob Shiller, with Gene Fama last year. So we have Fama on the one hand talking about rationality, but factor risks, explaining these differences, and then Shiller and the behavioral finance and economics people saying that investors are interested in lotteries, and coupled with the inability of institutional investors to keep the markets in line, that the noise traders, which have huge behavioral biases, lead them to overpay for these higher volatility or higher risk stocks. And professional investors are limited in their ability to bring things back into line. So, we have in economics, or in my thinking of things, it's like the man and the dog. And the man is supposed to be the rational person who's taking the dogs on a walk, and the dogs are these behavioral people with the leashes pulling them on the leash, and they're pulling them in every particular direction. So the man, without the man, the dogs would be everywhere. We'd have no equilibrium, because if everything was completely irrational, everything would be going all over the place. We wouldn't have any way to know. So the man makes money by pulling the dogs back and makes them come from on the path to the house and the like. But the behavioral people, such as Baker and Morgler and Bradley, claim that the low-risk return anomaly, that low-risk assets return more than high-risk assets than they should under any models, is one of the greatest puzzles in finance. And they claim that because investors like lotteries, they bid up these assets, okay? So that's the second school of thought. And the third school of thought is that there's a constraint on borrowing or leverage, and that investors who can't lever because the cost of borrowing is higher than the cost of lending, those individuals who like higher risk assets bid up the prices of these higher risk stocks because they can't borrow as inexpensively as they can get the same equivalent risk by buying the higher risk stocks. And this started with my colleague and co-author Fisher Black, and then argued for the markets being kinked in the sense that if you wanted to put your money into earning assets, you got a lower rate of return than if you wanted to borrow to get higher amounts of risk. And then it's led lately to many funds, but new papers now which say that this creates a flattened capital market line and the like. So, but we know that there are hedge funds, when faced with low expected returns, low risk, lever up to meet return targets, or people can lever up. And many new routes to leverage have been developed over the years, even though this phenomenon is just as strong today, the low-risk stocks outperforming high-risk stocks as it was in the 70s, or when we initially did our work. And so you now have many routes to leverage, either futures or options or levered ETFs. So the leverage constraint argument can't be explained as readily. So the paper that I was working on, this first component, with Ash Alankar and Peter Blaustein, really say the following argument. Investors rationally constrain their active investment managers by creating a tracking error constraint. For them to have a tracking error constraint, which means you can manage my money, but you can't be all over the place. You're on a leash, like the dog. Basically, you're on the leash. You can't go everywhere, because monitoring costs are very high for me. Explicit cost to monitor your performance is high. I want to be able to measure you or control you. And the less expensive way for me to do that, since it's hard for me to evaluate your performance, is to put a constraint on you. So in economics, we've always thought of the carrot and the stick. You have a carrot to attract people, the incentive, to do things, and the stick is monitoring or be able to beat them. But the third component is really under uncertainty. When you have a lot of uncertainty, you can't measure if the incentives are working, you can't measure as readily if the stick is going to work. Then an alternative is really to think about a constraint on the manager, constraining them to manage the money to a benchmark but allow for error, because if you have to stay right to the benchmark like an index fund, then you can't outperform. Anyway, you're right on it. So you have to give someone an ability to outperform, and so you need to give them that degree of freedom. And so third is investors who are hiring alternative managers to manage their money. It would be impossible to combine or create a portfolio of different managers because you wouldn't know what risks they were taking. If they were like the dogs running everywhere, you wouldn't be able to know what's happening. So investors want there to be risk parameters or controls on their managers to be with various benchmarks so they can designate their own portfolio. And additionally, I believe that managers want to constrain the constraints as well. If they have the constraints, they can stick to what their risk area is, and then within that risk area outperform or try to outperform, as opposed to having to figure out what risks to take in addition to their ability to forecast whether particular assets within their grouping are undervalued or not. So this leads to, in life, generally, we lead to an implicit or an explicit tracking error constraint on how we can act or what we can do. So the question is, does the tracking error constraint, when you pose a constraint on someone, there's a shadow cost to that constraint. There's a potentially be a cost to that constraint. And so we thought about that problem, and there's an explicit cost to monitoring. Is there, in the modeling sense, an implicit cost in the sense of a loss return by taking and imposing a tracking error constraint on us? You know, in other words, you have to stay to the benchmark, and you have to not deviate too much from what the benchmark is. And so the idea of an implicit cost, it shows up in the form of an opportunity cost or a loss return. Like, for example, people say, buy municipal bonds. You don't pay taxes on it. Well, you save the explicit tax, but you pay an implicit return loss in the sense that those assets tend to be bid up. So the question we had is, does the constraint itself provide an alternative explanation of the underperformance of high-risk assets? Do many unconstrained investors, investment managers, doing the same thing affect asset prices? So here, in our model, it turns out that the persons who are supposed to be the ones controlling so-called dogs, or the behavioral people, are doing exactly the same thing in our model, it turns out, as others are doing. So basically, there's an identification problem between whether there's behavioral tendencies which are causing these high-risk assets to be overbid, or is it our thinking, which is the tracking error constraint thing, which is leading investors to buy the higher risk assets? And do investor constraints play a role in explaining anomalies? And what we really believe is that my view of how investing works is my story of the elephant, okay? The elephant, if you ride the elephant, you get all of the movements of the elephant, all the factor returns of the elephant. So that's one way to invest, is just riding the elephant. You know, that's called the beta or systematic exposure. If you want to get sophisticated, I just think of it's riding the elephant. The second way to make money is called alpha, or abnormal returns. You know, how do you get abnormal returns? Well, one way to get abnormal returns is forecasting where the elephant's going to go. So the elephant's going to go over here, the elephant's going to go over there. You know, is the risk premium going to change? Is it going to be the case that earnings are going to change? All the wonderful things you hear about by watching CNBC and other stations. You know exactly where the elephant's going to go, or they tell you where the elephant's going to go, and they know perfectly where the elephant's going to go. All right, now, the elephant's going to go here and there. But the interesting thing is, what if you have a longer dated theme? Okay, what if it's the case that you say, well, the elephant's going to go here. I don't know where the elephant's going to go, but I know the elephant's going to go somewhere else in the short run, in the intermediate term run. So then if you have a tracking error constraint, basically what's going to happen, if you think the elephant's going to go over there away from the water, but if the elephant deviates very far away in the short run, you're taking a large error and a large potential loss relative to where the elephant's going to go. So you have to that's where the tracking error constraint comes in. If you're an active manager, you have to be pretty darn certain that the elephant's going to go where they're going to go, okay, and not because of that component. Okay, so that's the second way, but that creates tracking error. The third way to make money with the elephant is the dung of the elephant. Now, the dung of the elephant is rich in nutrients, okay? And the smart animals follow the elephant. But the elephant's dung is completely diffuse, most cases, from the elephant itself. And so those asset classes, which people don't want, you know, that's where you can make money. But then you have to have expertise to do that, and your tracking error gets very large. You know, whether you do restructuring, or you got like Elliott, you're reading in the paper today, for 8 years has been fighting Argentina to get money, okay? The tracking error is gigantic, okay, in that particular situation. So that's where the money's to be made, is the ability to take large tracking error, either by forecasting the future and knowing where the elephant's going to go, not in the short run where the cost of tracking error goes up dramatically, or following the elephant and seeing what the dung out there is, what people don't want. You pick that up, okay? That creates huge tracking error because in what you're doing. So tracking error itself creates an ability to make money because people sometimes knowingly give up returns because of this constraint. Now, in our model, what we find is the constraint, the tracking error constraint, causes people who are managing money to give up returns. And I call that the same way as the dung of the elephant, so I call that omega. As the resistance in the market builds up and gets to the point where there's a lot of people don't want to hold this asset, then basically those returns become more and more positive for that type of activity. So what we find is that if managers have liquidity constraint and a tracking error constraint, in other words, need cash to be able to meet redemptions or buy that next best thing, or have this liquidity constraints that we have where you have overnight ability to take money out, and then there's wanting to buy assets that have higher transaction costs, then the optimal portfolio is no longer mean variance efficient in the Markowitz sense. And to compensate for liquid cash holdings to meet investor needs, it requires that the performance drag is made up by the managers buying these higher risk stocks to mitigate the cost of the constraint. Because when you have a constraint, you don't necessarily just say, oh, I have a constraint. You try to mitigate it, and they will buy higher volatility assets. And so they add to their holdings of higher risk assets in the market. And with a tracking error constraint in a portfolio, and we did this in a very beautiful way to show hedging portfolios or hedging demands, so it was very nicely done and easy to see if you read the paper or get it. But what happens is the following: if you have an active manager, you're a manager who has an ability to either get alphas or omegas, that basically what happens with the tracking error constraint is if the manager likes high-risk stocks, the manager likes low-risk stocks, and the manager likes medium-risk stocks, how does the manager finance what they like? And it turns out that because of the tracking error constraint, the fact that volatility affects you, that basically it means that the manager would tend to use the lower-risk assets that have lower residual unexplained volatility, lower volatility, and lower beta, actually, to finance the things that they want to hold. Because if you sell off, if you have a constraint, if you sell off those things which don't affect very much of your portfolio, then you can control your tracking error. So they might not, so to finance the things they want, they retain the higher risk assets. And if they're, as active managers, buying risky assets, it means that what they're doing is they're bidding up the prices of higher risk assets and shorting or selling lower risk assets. But the interesting thing about our model, okay, is the following. In addition, it has dynamics. Unlike the behavioral models, unlike the the risk factor models, our model has dynamics because what we find in our model, that what you do, how much tracking error you take, depends on your beliefs. Okay, so if your beliefs are strong relative to your error, then you'll take more tracking error because you'll make more money. So the interesting thing is that what we predict and what we see from the data is that when volatility goes up dramatically, that what managers will do is get rid of their tracking error and go back to the benchmark. So in 2000, when you had the dot-com bubble, they were buying higher risk stocks. Their tracking error was going up dramatically, okay? But as soon as the bubble broke, they came right back to the index. And so higher volatility stocks in that case, because they had to sell them, did more poorly in a relative sense than the stocks they repurchased, which was their lower risk assets. In 2008, the same thing happened. The data really are amazing how they show how mutual funds or active managers behave because they came right back to the index. They overweight, mutual funds overweight higher risk stocks by about 10% relative to their benchmark, the S&P 500, and they dynamically adjust based on market conditions. Because look, if you say if you have a shock occurring, Well, shock creates all of us to not know things, then you'll go back and hug your index. So to take risk or extra risk, it needs to have your signal strength, and you have to have how certain are you of the strength of your signal. And the more uncertain we are, the more we go back to the herd, the more we go back to the benchmark. So that's a second dimension. And the third dimension is the constraint itself, which prevents cheating in our model. Because what happens is if I give you the bigger the leash I give you, the more I can claim that I'm outperforming, but I'm just taking extra risk to get that outperformance. So always in life, we have to trade off between who are the cheaters, okay? Do they have a skill? And how much uncertainty we have about that particular activity. So that has, the model has a lot to say about all of that. And then the demand for higher volatility stocks depends on the strength of your outperformance, your alpha relative to its error. And they will change the amount of tracking error they have given their strength. And this is important. So I think that when it came, and additionally, when it came to leverage, or the idea of, and the results themselves in the model turn out not to be small. You know, just tracking error that's imposed on management and on others. And it also has a big effect, I think, in thinking about uncertainty in that, even if you go to corporate finance and corporate world, the international world, because what we say is managers have too short-term horizon. You know, that's what you hear. They only want to follow the elephant in front. And one of the interesting things is that why not? You know, if you have a constraint, the board imposes a constraint on, or shareholders impose constraint on managers, they're going to stick to what their benchmark is as well and not deviate unless they think there's great returns to deviating for the error involved. And so, you know, it also applies to the corporate finance world. And one of the surprising findings of this work is that leverage, the use of leverage. We find that even if you allow leverage in our model, that people will stop using leverage and still buy higher volatility stocks or retain higher volatility stocks, even though they're allowed to lever, okay, to get more risk. And the reason, you know, it has the reason to do with the nonlinearities in the error, how the tracking error manifests itself, because that's a volatility effect. But interestingly enough, what we find is that if your manager has high returns, high reward, and volatility, then basically you'd want to restrict that manager's use of leverage. Because why? If you start levering, the manager then can start cheating by buying not doing any work, saying, I got all these skills. And so you don't want them to short alpha, you want them to actually use the skills and compensate for the skills, not to do it surreptitiously by taking just extra risk. And so, but on the other hand, if the manager's skills are such that he has low alpha but significant alpha, then you want to allow the manager to lever. So in our society, you know, we generally see that growth stocks and very high-risk managers don't lever. They're restricted to leverage, which we'd expect under the model. And similarly, lower-risk companies, such as bond investing or in banks or others, have used leverage for a long time, and because they would accentuate their ability to make money and at the same time be able to reduce their tracking errors. So I think that a lot of puzzles exist in our financial world, but we always have only used exogeneity. We've said these asset returns are given to us. If we add to this the idea of actual constraints within the system and people's investment and differences in trust, it makes a very big difference. I don't know my timing here, but want me to quit soon? 5 more minutes, okay. Well, then I better go on to my jokes. Okay, the interesting thing is the constraints, I think, in the model are actually quite rich for a lot of explanations of anomalies. But I think that in terms of the herd, or the idea having information or rationality, I don't think the herding is necessarily irrational. It's not animal spirits per se in the Keynesian sense, or in it's not in Greenspan's sense of irrational exuberance. In other words, rationality comes in, you buy information from those others around you. So those in front, on average, know more than those that follow. So if the car, and what we have generally in our science under uncertainty, and why we impose constraints and why we get involved in various things, is that the information set or the data set is vast. It's so large. I mean, we're discovering new things all the time. It's not as though we've exhausted very much of anything. So what we do is we build a model and we take a model and try and explain behavior or phenomena, and that model has an error to it. And so just as the error is positive or negative, and the greatest part of life is trying to decide, as we see these errors, whether the error has any information. If it's an error, that means it's an error. It means that we should ignore it. But there's times in which we look at the error and we learn from the error. We have to do things. So we have a vast data set. We take a model. We build a model that has an error with an expectation of 0. Sometimes the error is positive. Sometimes the error is negative. Without a model of behavior and understanding things, without that model, we have no knowledge. We just have intuition. So the intuition's a model, so we build a model. And that model then tells us how to act. So we have lots of models that we know in terms of international relations. There's lots of models that people use that have errors, positive and negative. So we get knowledge from a model. So there's knowledge from the model. So people who build models can build a lot of models that explain data, that we have. The real interesting question is, do we have wisdom from the knowledge that we have from the model? And even with wisdom, do we have judgment on top of that to be able to do various things? So the problem that we have is that in science, what we do is that deduction must follow from induction. We have to data mine. We take this vast data set. The only way in which we're going to develop anything is to data mine the past. And we use deduction to do that, following induction. Now, we know that's very bad, because what we can do is we can data mine or build wrong models. And so the error is not necessarily random. And this is from time series. And then the second problem is, when we build these models, we build them with clusters or spatial relations, and they're biased and incomplete, because we take a number of clusters and we put things into boxes easily once we know what boxes there are. But if you don't know how many boxes there are and where the boxes should be, it's very hard to define the clusters. And that in computer science, that's called an NP-complete problem. The computer would be ground. No computer could solve that problem today. So, who are the givers in life? Who are the takers in life? And how do you separate those? It's hard to sort these things out. And the point is that also the dynamics change. So the manifold we see in the clusters we see today are not necessarily the clusters we see in the future. And so clustering creates errors in our models. And the errors in the models are gamed against. One of the greatest things in the futures market, to relate it back, is called the cheapest deliver problem. If they specify the grade of wheat to be delivered, then people throw stones in the wheat, to get them so they can just pass the grade, and that's the cheapest deliver. So the error of the model is where the cheaters and the profiteers tend to work. Like in life, we know that reciprocity consistency of behavior, social proof, okay, under uncertainty, and liking people, authority, scarcity are all valuable benchmarks in which are rules which we use to create behavior among us all. But the cheaters game against us. They know we're going to do that. On the whole, on the average, that works. So there's a positive error and negative error. If they know the error of the model, they'll reverse engineer it and game against you. And the interesting things is that I think that is one of the problems with behavioral economics and the like, is that they have a model, and then what they do is they know your model, and then they give you an experiment. And they know your error, and they would give the experiment, so you're going to fail. Okay? Now, if, under my way of thinking, if they pay you 2 nickels to do it, okay, then, and your uncertainty of your model is large, who cares? So you'll fail, right? But if you pay a lot of money, so the alpha is high, and the error is not so great in its volatility, then you'll do a lot of thinking about it. All right, so a lot of the behavioral studies that are done, which show that, you know, people don't believe in reciprocity, they can fool them, or, you know all the tricks that you get when you want to make your friends. You go to buy a car, and the car salesman becomes your best friend. So he sells you a car, you know. But the trouble is he really your best friend, or is he selling you a car you don't want? You know, those sorts of things. So, you know, those are gaming against you. It's gaming against this uncertain model that you have. So it's sure. So you got to be able in a clustering world, in a framework, to be able to sort out the ones who are the givers and the takers. You know, we assume that we'll be able to function in that world. So it's like the story is, so that's why I think a lot of it, this going to tracking error, is that has to do with how much you're going to deviate from the herd, which is rationally keeping your models, depends on the loss that you're going to have or the gain you're going to have and the uncertainty around that. For small losses and a lot of uncertainty, you won't do much. For larger losses, obviously in the same level of uncertainty, you're going to spend a lot of time. And there's no learning allowed, no changes in the model. If someone keeps, it's a story, last story, and I'll stop here, even though I'll go on. But the idea is that this brother, older brother, in front of his younger brother and the older brother's friends, has 2 hands. One hand has 3 nickels and the other hand has a quarter. And the younger son keeps taking the 3 nickels and gives up the quarter. And all the older brother and his friends laugh uproariously at the stupid younger brother. And then the father, in exasperation, after observing this for several times, okay, then pulls the younger son aside and says, "Son," he said, you know that a quarter is worth more than 3 nickels. Why do you always take the 3 nickels? I said, "Dad, if I ever took the quarter, he'd stop playing the game." So it depends, you see. So I'll end there. Thank you.
Well, the game isn't over yet.
Okay.
Myron, thank you so much for those comments. We'll take questions now. We have some microphones, so please wait for a microphone and then stand up and identify yourself and ask your question. So I have a question right here, but while we're waiting to get you a microphone, let me ask you a question, Myron, about the core point that you were making earlier about the fund managers spending or over-allocating to high-risk stocks or high-volatility stocks. Have you tracked this compared to the performance of funds to actually see what the performance of funds would be?
Right. Yes, I mean, I didn't have a chance to expand on it, but what we find is that when dynamics occurs, then as predicted by the model, the returns also are there. So if managers, if you look at the average performance, we created this huge mutual fund, which is one fund, okay, based on their holdings. We found that basically if you look at the returns on a fund versus, say, the index and look at their excess returns, that it's not very significant, as most people have found. Say active managers don't outperform generally. But what we did is we also then included their overweight in a subsequent regression to the higher risk stocks. And what we found is that they could outperform, but it was the cost of the overinvestment in the high risk stocks that ate into a lot of their returns. So on the one hand, they made the extra money. On the other hand, the constraint itself lost. So in other words, they can make money by buying the higher volatility stocks, they can make money by buying middle volatility stocks, and they made money by buying low volatility stocks, but they had to overweight to the higher volatility stocks to control their tracking error. The overweighting that they did to the higher volatility stocks was a cost to them and ate into their returns.
And then over time, it gets more and more difficult for them to outperform the benchmark this way.
Well, when they have the constraint, yes.
Yeah.
So the question is then, it's like, if there weren't cheaters, if we can figure out how to get the correct cluster, we should need two. I always wanted the airport. I was trying to tell the airport, the TSA, they should have two lines. Terrorists go to this line, and no terrorists go to that line, and then everything would be easy. We'd have no problem. And that's unfortunately, it's the cheaters in the system that are causing the great difficulty, and we have to figure out in any delegated monitoring world, or which you're trying to rely on others, your politicians included, as to who is telling, the straight story and who's not.
Okay, so we have a question right here.
So,
could you identify yourself, please?
So yeah, my name is Naved with Next Capital Group. My question is regarding these low volatility smart beta products have been coming out last 5 years. Some for the US, international markets, emerging markets, and they tend to have like 0.8 beta relative to the main indexes and higher Sharpe ratios, like 20% higher, 50% higher Sortino ratios. Can you, based on your research, basically create a global portfolio and lever them up to the same level of volatility and get higher returns than the global equity market indexes using this methodology? And the second part is, if you have these tracking errors for individual mutual funds and you're trying to track some standard asset class portfolios, which is what everything in the 401k space is about, is it better to, in a simplified manner, to just assume the benchmark and just fill in the pie, or to actually try to do an optimization over these funds with all of their sloshing around on how they're actually behaving to track the asset class portfolios? Or do you just, is it better to say, you know what, they're sloshing around, this is a small cap manager and we're going to treat it as a small cap?
Yes. It's going to take a long time to answer that question. Actually, very technical. No, we should maybe have the 1-minute questions first and then the 10-minute questions. But just I'll answer quickly in terms of everything is the idea. This is the idea of having the data mining, where you look at these things and you get labels of things, whether you call it smart beta or super smart beta or dumb beta or whatever it is, and someone then looks at the previous data and they found that there's differences in returns on different asset classes, such as the lower risk stocks, and if it's the case that on average that's true, would it be nice to have an economic explanation for it as opposed to the explanations that are used? And I think in this modeling, internationally, what it is, it's like a concatenation, because you get, even if you're in a lower risk asset class, then you still have to control your tracking error relative to your new benchmark. Therefore, you're going to buy higher risk securities. So it all goes up the chain that, it gets overbid as well. Yes, ma'am.
Oh, I have to stand up. Thank you, Professor Scholes. My name's Cecilia Mowat with Strategies Insight and a Stanford alum. So thank you for being here. Go Cardinal. The question I have is, we're talking about global markets and modeling. And I'm wondering how the model is changing as the global financial markets are changing. And you say there's no lessons learned. Can you talk about looking at changes in the emerging markets and the economies of those and the impacts that might happen there? And can you also talk to any of the different modeling groups, like the factor model and the like, coming together to do something a little different, the behavior, combining those, a la the Scott Page concept of diversity and high-performing teams come up with different ideas?
Right. Well, one of the things, if we have, the global society ends up having the same information set, then there's going to be less diversity. So the interesting issue in our science is if you have hunters and you have farmers, or you have war generals and you have ordnance generals, then basically to create innovation, and that you need someone who's going to deviate from the herd, is going to have lack of tracking error and willing to do various things. But in our society, if generally we pull people back to the herd because we don't allow them to deviate to become war generals, or we don't allow them to become hunters. Or, I read the book by on Guns, Butter, and Steel, by Jared Diamond, and said that the farmers drove out the hunters. I wondered where the hunters went to. They didn't disappear. They just were driven somewhere. And that's the point, is in that if we set the norms, which are based on what normal behavior is, then to deviate from the herd, it has to be the case that people have great reward for the risks they're taking. So if the information set becomes too common, then it's going to be more difficult for people to decide to deviate. Or if uncertainty increases dramatically in our society by various actions, then people don't have the degree to deviate. So the interesting thing is that the innovation we see, the great innovation we see, has to come from those who don't want to stay with what is the norm and what's being done in the herd. So that creates it. So in the international context, in the like, then things that are developed internationally are more idiosyncratic for those regions, and not necessarily there's commonality because of different places in which people started from. So I think we have to always respect that in terms of how people are going to innovate, create new things.
Okay, next question. We have one over here in the front. Get a microphone down here, please. Thank you.
Professor, my name is Shep Pryor. I'll identify myself as a former student of Dr. Scholes, but it goes back a few years because it was here at the University of Chicago. Question, you've found a systematic or a systemic shift or systemic potential profit opportunity, it seems to me. This was something we used to worry about in your classroom. If the culture is forcing all of the investment managers to hew to the tracking error constraints, doesn't that open a big opportunity for someone who throws away those constraints? I suspect they'd have to have a tremendous amount of funding, but then in the past we talked about, well, you just collect enough money and build enough of an effort, and maybe you can ride the curve in the other direction when it does revert to the index. So have you re-engineered your own model to find the profit opportunity?
Well, I guess everyone wants to trust me. Just give me your money and come back in 10 or 15 years, and we'll be fine. No, I mean, the issue is it's trust, okay? We hear that word, and the interesting thing is that when you build this model, then you see how all these cheating behavioral things come into play, and that it creates the idea of, obviously, those managers who garner the trust of their investors have an ability to deviate quite considerably. So it's sort of, and have a longer horizon for their investments. And so we've seen in our society various things develop, presumably the development of like private equity or private investment world, and the old merchant banking world of the past, which basically said that if I have time and patience and at the same time realize what the opportunity is and trust my advisors or those who I deal with, then basically you can make more money. And that's really the arbitrage. It's the idea of the short-termism that's manifests itself by the tracking error constraint itself, which causes people to be not able to deviate that much. The leash, is too binding. But why is the leash binding? Because basically it's a matter of trust, and it's a matter of trying to figure out alternative ways. So we have to figure out in the future an alternative ways as opposed to staying with the herd and don't deviate too much from the herd.
Got a question up here in the front? Right here.
Thank you very much. Phil Levy with the Chicago Council. So you described a dynamic model where you would have people sort of get closer or farther away from the index. Is it possible to tell in real time where we are in this kind of a cycle? And do you have any observations about the present state?
Yes, we can. That's research that I've been doing. And I have an index, a tracking error index that I built for mutual funds. So I know where they are and how much the tracking is there. So there's the idea of using the markets to figure out, how much tracking is going on. And then also at the same time, you could use the market to figure out when the system is not working as it should, when the error itself is giving you information that, the herd is not working, anymore. Things tend to be breaking down. And so you can do that, but you have, in science, you have to focus on things. If you focus on a particular part of this vast information set or forest, then you're going to think one way. But if you start thinking in a different way, then you can immediately start seeing opportunities to find information. And so there's a lot of information. There's information in the options markets, is when people are getting more uncertain about whether to deviate from the herd because their uncertainty is increasing, and therefore they tend to move back to the herd. So there's a lot of things you can do. Actually, right now, everything is very sanguine, actually, as it turns out. I mean, if you look at the markets, and the saying is that, there's a lot of deviation. Maybe it's the case that the only things that are harder to predict is when you get just shocks, whether, say, the Middle East blows up and all of a sudden, everything changes, that model changes. We data mine and we have a model, the markets. The question, a lot of times in the markets, the risk views and how much deviations occur change more slowly. Even in 2007, 2008, it didn't happen all in one day. It evolved over time. And even though I know all of you came to hear Geithner and Paulson talk about how wonderful the government was and they couldn't see anything was happening, the markets were telling a heck of a lot at that time, what's happening. The market risk was increasing dramatically in various facets. You can see it if you just looked at the prices and you concentrate on how that was going, what was happening. But the government officials always think they know more, and so then the markets do. And one of the things you learn is the markets know more than the government does. So.
I've got a question right there.
Good evening, Professor. What would you
Stand up, please.
What would you say one of the biggest mistakes people make in investing is?
The biggest mistake in investing is not believing in the markets. The herd is, on average, right. The idea is sometimes the herd has a positive error, sometimes the herd has a negative error. But the biggest mistake is in thinking that markets completely irrational, and therefore change the risk dynamics of their portfolios without really realizing that they're not buying the information correctly.
So you gave us, is there another question? I didn't see one.
Lots of them.
There's one over here.
James Brewer, and I'm from that other school you taught at, MIT. So it seems to me that one of the problems that you kind of addressed earlier was this issue of knowledge and wisdom and judgment. And it seems that we have layers of investors So we have those who have more information, who came here tonight to hear you, and then we have the other people who are just listening to whatever the 6 o'clock and 10 o'clock news are telling them. So don't those dynamics also crash and kind of help to create the trust problem and a lot of the other problems you talked about today?
Yes, I would agree with that. I think that there are, more fundamental issue in terms of thinking about investments, you said, was how to separate out in this information vast those who are cheating and those who are telling us the truth. And unfortunately, in our society, when we know that's the case, there are cheaters and the like that, and profiteers that basically when we get information we should act on, we don't, because we don't trust them. I don't know if you've ever watched the Jon Stewart show, which I enjoy watching, but that's exactly what the reporters do. They go to talk to someone and said, do you believe in guns kill? No, I don't believe guns kill. It's people kill or whatever it is. So, but the way they do it is set it up exactly to know the error. Okay, and they ask people questions, so the people know they're being gamed against, or they don't know they're gamed against, but it doesn't matter, because when you have this combination of those you trust and those who are not telling and those who are cheating, that basically it's very hard to sort that out. So you tend to ignore all information from time to time. And so the interesting thing is how that's, when you talk about international relations or affairs, by the way, is this affairs like sexual affairs, or does it have to do with
whatever you want?
Global sense. I'm just a naive professor, So, the data set. Anyway, in terms of what's happening, even then we see that the models that are being built under the vast amount of uncertainty are just full of error. And then the question is that a lot of data mining occurs within your world, which you're trying to sort out through your studies and at the same time through your research and thinking.
Well, unfortunately, we're out of time. We don't have time to go into the affairs question. So, ladies and gentlemen, please join me in thanking Myron Scholes.